episode of Finance Footnotes. I'm your host, Brent, and today I'm bringing you a slightly different format called the Fast Five. I want to start by asking you a quick question. How are you feeling about the stock market at the moment? And if you're like any of my friends and family and colleagues, I think you're a little worried. I think confidence has kind of fallen off a cliff here in the last couple of months because of some of the inflation data, some of the things going on in the Trump economy. So I want to share with you a couple of notes to make you feel some more optimism and why you should stay the course. So let me start by telling you your pessimism, you're feeling the exact same way as almost everyone else out there in the marketplace. The first here is Consumer Confidence Index, and this is from the NBER. This is the common metric, and the chart I'm showing you is from the last 18 years. And if you followed the data in the last week, you may have heard the data point, the statistic, that it fell 7 points in February month over month. It was the largest 1 month decline in the last 4 years. That was the stat that kind of worried me, and I was a little concerned until I looked at the chart and saw this data is very volatile. It jumps around a lot, but certainly an indication that people are feeling a little less confident about things going forward as they were. Next chart I have is from the CNN Fear Greed Index. This is a chart that we've cited often here in Finance Footnotes. You see it elsewhere in financial periodicals, and it kind of takes 7 important measures and variables, and it consolidates it on a speedometer here. And right now you can see that it's at 19, a rating of 19 of 100, in extreme fear. People are very pessimistic at the moment, very pessimistic. In fact, if you look at the bottom of this chart, you'll see a graphic that shows we're basically at a trough right now. People are the most pessimistic they've been in the last year, according to the CNN Fear Greed Index. And the final chart, American Association of Individual Investors, the AAII. And I have an arrow pointing to last week's data at the very end of February. Something very unique, very unusual happened. The number of bears or pessimists in the marketplace, those that thought markets or stocks were going to go down in the next 6 months, was above 60%. And bulls, those who thought things were going to get better in the next 6 months, less than 20%. That polarization is very uncommon. It's very unusual. And it's a point for us to kind of put our ears to the ground and say, what's going on here? And so just highlighting the point that people are very, very unhappy right now. The newsfeed is very negative, very uncertain. And I want to start by reminding you of a famous quote from a famous investor. And then I want to share with you 4 ideas why you should stay the course or maybe even consider putting money to work here as things are at peak pessimism, okay? So that quote, of course, is from Warren Buffett. His most famous quote probably is, you should be fearful when others are greedy and greedy when others are fearful. It's a great idea. And of course, people are very fearful right now. So maybe it's a good idea to be greedy. And that first chart that I have for you takes a swing at that AAII data. So you're seeing a lot of green on this particular chart. And what it's doing is looking at all the occurrences since 1990 when there was 40% difference, the net difference between the bears and bulls. So right now, for example, at the end of February, there were 90% bulls and greater than 60% bears or pessimists, meaning that there was a difference of negative 41%. Anytime it's been over 40%, there have been 10 times. The next 12 months have looked awfully good, right? This is peak pessimism. This is exactly what Warren Buffett just told you about in the last slide. And you can see that there's an average of 22% median return over those 10 previous occurrences, positively higher 9 of the last 10 times, and that one time it was basically flat. So this is a very good indication that we're at peak pessimism and things could improve over the next 12 months, okay? The second idea here, slide number 3, is just letting you know that this volatility is very seasonal. This is very normal. It's often the case that January is positive and February is negative, and this data comes from our friend Ryan Dietrich at Carson Wealth, and it's showing you that since 1952, there have been a handful of times, about 13 since, that the markets were positive in January and then negative in February. When that happens, typically the rest of the year, the following 10 months, is positive 75% of the time based on this metric alone, okay, with an average return of 10%. Falling on that seasonality, we're in the first year of a presidential cycle. This is a post-election year, typically in that year, on average, going back to 1950, okay, 75 years of data. January positive, February negative, March, April, May, all positive on average, okay? So we have to be careful when you use averages, but this is an indication that things are normal. The final chart I want to share with you is, yes, volatility is up. The market has been very jumpy and choppy over the last several weeks. It's up 24% year to date through this morning. Feels very uncomfortable, especially because the last 18 months were particularly calm in the market. And so the last chart I have for you is probably my favorite, and it's, again, from our friend Ryan Dietrich at Carson Wealth, and it's showing you that there have been 5 days in a row, and if today's stays the course, it will be the 6th day in a row where markets are up or down 1% or more. That's very unusual. In fact, 33 of those 39 times were positive, for an average return, a median return of 17%, 85% of the time over the next 12 months. This is a very positive indication that things could bounce here as people turn from their pessimism to their optimism and markets follow suit. Everyone feels pessimistic at the moment. It's very natural, but if we're smart enough to follow Warren Buffett's sage advice, it might be a good time to, at a minimum, stay the course, not pull chips off the table, and possibly consider adding to your stock exposure. So I hope you found some confidence and value in this 5-minute conversation. If you have questions, please let us know. Otherwise, see you next week on Finance Fundamentals.